Well, never a dull day in the markets right now. It's great to have you with us. We are knee-deep in earnings stories, and so far out of the technology sector, the lights have been bright. Speaking of technology, the AI boom is front and center this morning with big spending plans on infrastructure. So the tech theme is alive and well. Of course, though, there's uncertainty in the air as measured through the uncertainty tied to tariffs and the Trump presidency. To make sense of these markets, we're joined by David Burrows, one of our great regular guests here and chief investment strategist at Barometer Capital Management. David, nice to see you.
Great to be here.
Let's start with the tech theme, because I think through the eyes of investors, this is a group that had a huge run and everybody was wondering if that run could continue. And this morning we've got a couple of examples of tech strength. One, just sheer performance of a business, and the other, a sign of where AI might be taking us. What is your take on all of these headlines?
Look, we're in a world where the big continues to get bigger. If you've got a competitive advantage, you continue to build on your business. We went from June until December. Tech sort of took a little bit of a backseat to some other sectors. These things don't go straight higher, so they were sort of churning and correcting. But it is clear that this AI theme is one that's going to continue, that there's going to continue to be very significant capital put to work in the area, and there's going to be winners in a bunch of different areas that are able to take advantage of that. On the Netflix front, the big communications platforms have shown their dominance and their ability to get paid, right? Ability to generate cash, and not only are they growing their subscriptions, more quickly than anybody expected, but at the same time, they're able to raise price, and that's a really good combination.
It's pretty incredible when you think about the fact that in 2022, people were writing off Netflix because we started to see some weakness in the subscriber numbers. The biggest takeaway for me from that was, because you said it earlier, the big have a lot of options. The powerful platforms have a lot of options. We actually saw this with Facebook's parent Meta as well, when they were down and potentially out for the count, and they just pushed a few buttons around. I mean, Netflix said, okay, we're going to crack down on password sharing. We're going to introduce an advertising component. Oh, and yeah, I know we never clarified how much live sports we're going to do, but we're just going to start driving into that, and that's driving all eyeballs. And I think since those lows in 2022, the stock is up more than 400%. Now, I guess one of the questions analysts or even investors would have is, when you've had that big run up, what do you have to think about? Because I did see a lot of analysts upgrading the stock today. But how do you think about the fact that they're delivering on the bottom line, but again, the stock has had a big run already? Yeah. How do you think about that?
Look, I think that what you have to take away is, in a business this big with so many subscribers, they have a lot of different levers that they can pull. And you're driving a very big ship. But small adjustments can mean big changes in the numbers. There's just a lot of horsepower in that underlying engine. And we're seeing it. What they're doing in live sports is kind of a big deal, because it's still relatively early stage. And while, for instance, in the Jake Paul fight, they had some difficulties with their technical side, they had like 60 million people online trying to watch this event. So they'll figure that out. So these are things, I think, that small adjustments can lead to a lot of cash generation, and we're really focused on that, where Netflix has been a holding of ours for a long time.
I don't know who's Jake Paul and who's Mike Tyson in the AI world, but everybody there seems to be battling for supremacy. Maybe there's plenty of market share for everyone to enjoy, but this story about OpenAI and SoftBank and Oracle focusing on AI infrastructure, backed by an incoming president who's supportive of all this, is one of the other tech themes this morning. Any takeaways there?
Look, like in anything, you want to focus on the leaders. And in a world where there's going to be lots of noise, next 4 years are going to be more noise in the market. There's going to be more overnight news that we're going to read about.
Yeah.
We want to always be taking signaling from what the market's telling us is going on. And through the course of time from sort of June to December, while semiconductors in general were weak, NVIDIA was able to kind of buck that trend. It showed its true power against a weak market. And we're seeing that. They continue to be pretty dominant. And the dominant companies, the ones that are hold up best in a weak market, are likely the ones to continue to do well. And there's just no sign at this point that NVIDIA is running out of playing room.
How do you balance that with all the other parts of the stock market, which deserve plenty of attention? There's more of those companies. It just so happens that the tech companies make up more of the broader American market. But you have the tariff worries. We're trying to figure out what it means for Canada. All sorts of industries, including natural resources-based businesses, are trying to figure out what that means. I was alluding when we started the show that drill, baby, drill is kind of an exciting theme within energy, but we don't know what it's going to mean for oil prices specifically. Presumably could put some pressure on oil prices. So as someone who watches all sectors of the market, how do you think of the non-tech basket of investing?
Listen, some of the leading themes are not technology. You know, financial services has been remarkable in Canada and the U.S. and frankly globally over the last 52 weeks, and they continue to be very strong, whether it's the large banks, whether it's the capital markets banks, you know, the brokers, whether it's the insurance companies, they're performing really well. They generate a lot of cash and they generate nice dividend growth. A lot of the big resource companies generate a lot of cash and have pricing power and have nice dividend growth. In a world of a rising cost of living, investors in general are looking for ways to have a rising stream of income, and we can get that from some of these sectors that benefit in an inflationary world. And so outside of tech, we really like materials and energy. We really like industrial companies. We really like financial services. And there's lots of money being made in those other sectors.
So a good chunk of those industries that make up the TSX have had a nice 12-month run. Can I take from what you're saying that you feel like broadly investing in the TSX isn't a bad thing you could do with some of your money?
I know we're all concerned about tariffs. And clearly there will be some sentiment driven by whatever comes. But we've all had some time to worry about that. At the same time, there are some sectors that are broadly benefiting from what's going on in the world. And the TSX has a heavier component of financials, industrials, materials, and energy. All four sectors look interesting. So outside of that news, you can't ignore it. And they're behaving pretty well, even though we worry about tariffs.
Okay.